and to lower the cost of everyday needs like healthcare and housing and groceries.
We're going to end America's housing shortage. You just let in over 10 million people illegally, and you put them all on housing vouchers and food stamps. You caused America's housing shortage. If you care about the cost of housing, limit the population. Certainly don't expand it through uncontrolled immigration, through open borders, which is exactly what they did. She's responsible for it. And her donors at BlackRock are buying up the houses in your neighborhood. And her donors at Airbnb are turning your neighborhood into a completely unmanageable garbage, a place filled with transients where there's no social connection at all between people. Those are her donors. Those are her policies.
It is my pleasure to welcome Brad Smotherman to the show. He is an expert on creative financing, a podcast host, and he has done about 1,000 deals. And he is looking for that cheap money that exists in the mortgage market. You know, I've talked many times before about how around 25% of the country has a mortgage at or below 3%, and about 65% of the country has a mortgage at or below 4%. So it is a phenomenal opportunity if you can take over those cheap mortgages. Brad, welcome. How are you?
Doing very well, man. Appreciate you very much for having me on.
It's good to have you. And you're coming to us from The Truman Show, right?
From The Truman Show, Seaside, Florida. Here we are.
Yeah, good stuff. But you are from Nashville, and you've seen Nashville grow a whole bunch over the years, of course. Do you want to speak to that just before we dive into
being a real estate guy, I have mixed feelings about it because it's been very, very good for our company and very good economically for the area, but also coming from an agriculture background where we were farmers, the life that I remember growing up really doesn't exist in that market anymore. So like with every change, there's good and bad with everything.
Yeah. But, this is really, folks, I mean, just think about it. This is what happens when you have this massive housing demand. I was on our Empowered Investor Pro Zoom meeting yesterday and presenting some population stats. And, just since, the early 80s, I mean, the population has increased by like 120 million people or something like that. So there is just a giant demand for housing and people have got to live somewhere. These population stats are probably understated with all of the illegal immigration going on. And plus, we're halfway through the decade and the census is only every 10 years. So let's keep that in mind as well. So a lot of housing demand. Brad, give us your kind of outlook on the real estate market, if you would. When I say that, I'm probably talking about the for sale market, the buyer and seller demand and supply levels. But then I also want to do a part two of that question and talk about rental demand and what you see there.
For sure. So I think it's interesting times in the market, and I appreciate you prefacing the question with the sales side of the market, because everybody's like, well, is it a good market or a bad market? It depends on if you're a buyer or a seller in that market cycle. And so everybody really looks at a good market as being from the seller side of the market. And I think we're in really interesting times. Right now, at the point that we're recording this, it's really right before the election. I do see that the election begins to put a hamper on buyer demand. I really saw this for the first time significantly in 2016. And we had stuff going on in the market in areas where we actually bet over under whether we were going to have more or less than 14 offers on a house going on the market. And it sat for 30 days. Wow. And we didn't get, And it was right before that election in 2016. And then it ended up going multiple offers and closing in December. So it was very, very interesting that I saw that for the first time. And I am seeing that again. But it's a really strange market, man. And I think you would agree with this because we're hyper undersupplied, population's growing. So those are really, really good macro metrics. But we're also in, on a 10-year curve, a higher inflationary environment, higher interest rate environment. Jobs seem to be have a little bit of pressure in terms of the jobs market, and it's softening up a little bit. And so, but this inflation has really, really hurt people. And, on our purchasing side, where we're purchasing from motivated sellers, we're seeing a lot more financial distress than we've seen in a long time. So I think that it's a really interesting market. I think anytime you hold something for 10 years, you're going to be to the best. And I still believe that. I still think that real estate is the way to go. Do I feel like we may have leveled in terms of pricing or potentially may dip a little bit in some markets? I do think that. But it really depends on the market. And this is where we just come to buy really, really good deals. you know?
The infamous George Soros has this philosophy, that he's done really well with. It's called reflexivity. And this isn't exactly what he talks about, but I sort of liken reflexivity to what people tend to forget when they're trying to sort of forecast the market or figure out where things are going is they forget about the way the central planners are going to react to things. And this is how a lot of people got it wrong during COVID. Even, my friend Ken McElroy, that we're partners in a mastermind group that we run together. And he admitted he got it wrong because during COVID, he was saying the market is over, it's dead, don't do anything this year. There were all these, very doomy videos. But later he said to me, what I didn't really consider well enough is how the Federal Reserve would react to the crisis. And of course, they just massively pumped the market with money. And Jerome Powell became Helicopter Jerome. They talked about with Ben Bernanke. Helicopter Ben was the saying there, that he would just dump money from a helicopter to fix the economy. That's the thing we're seeing right now, right? The Fed has announced that they are going to pivot. Right. Yep. And just take a look at this. I'm going to give you some thought. Look at this. We took a baseline interest rate of 7%, right? And of course, rates are a little lower than that now, thankfully. It's about time. But we started with that as a baseline and said, look, if it goes to 6.5%, how many new buyers can qualify for the median price home? And the answer is 2.8 million. And then if it goes to 6%, how many new buyers can qualify for the median price home? And the answer is 5.4 million. And then if it gets way down to 5.5, which by the way, Fannie Mae is predicting, right. Okay, well, I don't know if they're going to be right or not. I mean, the Fed is really in control of that, but that's 7.7 million new qualified buyers who can afford to buy the median price home. And you look at something like this and just think, there's only 700,000 homes for sale in the country. I remember, Brad, a moment ago, you were talking about, you would make bets with your team. Are we going to get 14 offers or more or less?
Yep.
When you see stuff like this, just comment on it if you would.
Well, it's really interesting. I'm concerned about the buyer side of the market. I have an employee at my office and she just bought her first house. She spent $250,000 for an 800 square foot house that needs work across from a cemetery.
And in what city, by the way?
In Nashville.
Okay.
And so, when I look at my first house is 150,000 and 2,200 square feet in a good neighborhood, and how difficult it is for people to come up. And you look at the average American, a lot of their wealth is held in housing, their primary residence. So
it's really made in their housing.
Correct.
Right?
Yeah. It's a great wealth building tool that a lot of people, seniors, cash out with reverse mortgages or sell and go to assisted living and use that equity to live. And, the ability that people have to accomplish that is continually being squeezed.
Yep.
And I have a deep concern for buyers in the market that, yes, I mean, as the money gets cheaper, that's great. There's more affordability in some aspects, but in other aspects, I mean, people are being priced out of the market completely. And I think that going back to a 2021 market where it was common to waive appraisal contingencies and home inspection contingencies just to get into something was a really difficult place for a lot of people to be.
The only way that this crunch will be solved is to simply build more houses or have less people. That's it. It's just simple supply and demand. And we are massively undersupplied in this country. Of course, the estimates vary, but we're just massively undersupplied. From the investor side, it bodes pretty well for the rental market. It also bodes well for appreciation, of course. What are your thoughts on the rental market when we see very typical rents being $2,000 a month or more? That's a change.
Well, it is a change, and it goes back to the staple: if you buy well and hold, then you're almost always going to be okay. I try to stay away from the words always and never if I can. Yep. So you're almost always going to be okay. But it goes back to affordability. I don't know how the average family does it. I look at the people that we have working for us and I try to pay people more than what they could probably make out there in a similar position. Number one, because that serves me best. I don't have to continually train people because we keep people. But at the same time, if people bring the value to the company, I want people to make money. I have a deep concern for the average American right now with these prices inflating, but it's a great time to be a landlord if you've held these properties for more than 5 years.
Yeah. Yeah, no question about it. But Brad, you see this pressure on housing. And I think the answer to the question is people will just simply have to learn to accept less. We've all sort of got it in our heads. And I think the baby boomer generation taught us that. This idea of the American dream, a house with a white picket fence and a nice suburban neighborhood. And, that's just not the world anymore. It's just different. It's kind of like moving from, say, moving from Nashville, because we'll use that as an example, to New York City. Of course, when you move from a low price market to a very high price market, you're going to have to learn to accept a lot less than you got before. Whereas in Nashville, you might get a 4 or 5 thousand square foot house, and that same maybe $1 million buys you a 650 square foot apartment in New York City, right? And that's the way it is. That's what gives when economists try and predict the market and say, housing is just unaffordable, the market's going to crash. Well, not really. People capitulate, they make different decisions. They just get the best thing they can at the time. So, thoughts on that?
I think that that's true. And I think it's very interesting for the people that continually look for the next market crash that has yet to happen for, a decade.
Yep.
I remember, and I'm sure you will too, man. At first it was shadow inventory foreclosure. There's going to be this next round of foreclosures that never came. And then, we had swine flu, and then COVID was a big blip in the market. Nobody knew what that was going to be. And there was a lot of unpredictability in the market. But most people said this is the crash. It's here with COVID, and that didn't happen. Right now there are people saying, well, the Fed is going to crash this thing. And, but I think the macroeconomics, supply and demand, you look at those curves. I mean, there's no way. The thing about real estate is crashes can't happen quickly. Even in the 2008, 2009 market, you would see pricing come down maybe 2-3% per month, where stock indexes can do that in half a second.
Right.
So you have a certain amount of stability in real estate that you don't have in other asset classes. And I think that that's really good. But this idea that, all of a sudden we're going to crash, I mean, it would take so much to have to happen outside of a black swan event. I mean, and of course, World War III scenario, nobody has a playbook for. But, outside of a black swan event, I just don't see it. I don't think pricing is going to come down that much. And I agree with your assessment. I mean, buyers are going to have to really change what they expected.
Yeah, they're just going to have to accept less. That's what always gives, is people just learn to accept less. But if World War III happens, for example, of course, what will happen is another Fed pivot, right? The central planners react to the market. They don't want the economy or the housing market to crash either. Okay. The people in power want to be reelected. And, that's always a huge, huge motivator. All right. Well, talk to us about what you're busy doing in terms of what you are buying, what kind of deals you're looking for, and how you make them work.
Yeah, I think the way that we've done the business has really been the same effectively for the past 10 or so years, but the way that we have exited has changed over time. So in 2010, I started as an investor. I had very little. I had $300 in the bank. I was 23 years old and, had to chase this dream of maybe owning something one day, so fresh out of college. And, everything that I did from 2010 to 2014 is I would put a contract on a house subject to, and then I would sell it with owner finance and create notes. So I'd create a down payment that would be better than like a traditional wholesale deal, but I would have this long-term asset in a note that would cash flow. And so I was building my cash flow over time. And then, so all of that was really good up until the market really started to kind of recover in 2014, 2015. So that 2010 to 2014 market was very, very easy to buy in, but more difficult to sell in. Well, owner finance really solved that because they're in tough times, banks tighten their lending perimeters and more people need owner finance. So it's actually easier to owner finance really in tougher markets. And so in 2014, 2015, the market started to stabilize, started to recover. It became more difficult to buy and easier to sell. So at times we would go more retail to cash out houses and really just, exit, take the cash. And so that was helpful. And now we're really doing a combination of both of those things, but then also keeping a lot as rentals because there's so much, like you said, 2-3% money that we're taking over. So we're not qualifying for the loan. We're not assuming the loan. We're just taking title subject to that existing lien. And then we continue to make payments on it. Okay. And so we're taking over these assets that have, equity in price, yes, but a lot of times the real equity is in the rate. Because if I was going to go qualify for this turnkey rental, it'd be an 8% rate. But we're getting it at 2.5%, which if you factor inflation is a 0% rate. So we're really just building the asset base bigger and bigger and bigger because we want to hold more assets, through this inflationary environment.
Mm-hmm. And how do you find those deals?
Let me go back and go more macro and then more micro.
Okay.
I think that good deals are not just found, they're also made. So I think that you can have the lead, the seller lead, and be bad at a process once that lead is captured and still not maximize. But in terms of how we are going to really find leads, we want to be found. So I think that there's a big difference in like me asking someone to sell me something, which would be direct mail and cold calling and those kinds of things. You're asking everybody to sell you something. I want to be in a position to be found when someone is asking me to buy something. And so almost everything that we do is search related. So the major search engines, like as an example, man, years ago, I had a lady that typed in sell my house before I burn it down. Sell my house before I burn it down. I took that call. And
well, you don't want to have that in your search history if you're ever filing an insurance claim.
That is probably true. But the funny thing, man, is she said, Brad, come and buy this house before I burn it down. And my ex-husband's in there. And I was like, whoa, we got ourselves a lively lady here.
Wow.
I went, I bought it, and I found out that it was her that searched that because I was looking at my keyword report and there was somebody that searched sell my house before I burn it down. I said, that was that lady. So we're in a position where people are searching because they've already identified that they have a problem. They find us. And right now we're buying one in every 12 leads. So 12 leads come in, we buy one house. So it's very, very efficient.
Mm-hmm. Yeah. Okay. So you're advertising, you're doing SEO. I mean, you're obviously running a business, right?
Correct.
With, how many employees do you have, or how many team members, I should say? Because
around 20.
Yeah. Okay. So you've got 20 people on your team and you're doing this in different parts of the country, right?
Correct.
Yeah. Okay, good. And are you advertising for people with low rate existing mortgages for subject to, or are you not advertising that specifically?
So we're advertising for the.
Are you just saying, if you want to sell your house, right?
Yeah. So we're advertising for the problem, not the property.
Okay.
So I believe that good purchases are found with the problem first. So these problems, pre-foreclosure, inheritance, tired landlords, health and safety. I say safety because we buy close to a dozen houses per year from people in abuse situations, either elder abuse or spousal abuse.
Oh,
so
wow.
if we can source people that have problems associated with real estate, then we're going to have the properties that are good, by default, just because we do it in volume, and like you said, a majority of rates are under 5%. And so I see value in a sub 5% rate right now. So if we're getting these people that have problems, we're having conversations with them, and then take them through a process of negotiation, then at some point we're going to find out what the mortgage balance is, what the repair cost is, what we expect that the value is. And then in part, hey, is there a mortgage we need to take care of if we buy the house? Okay, great. Is it current or a little bit behind? Approximately what's the rate? And so we go through that on the first phone call. And then we're deciding, okay, is there potential equity just in the rate? Because if something, again, is at 2.5% rate, I may want that deal if it's got a 10% equity position. I may not need a great equity position in price if it's a turnkey house in an area that I like that has a 2.5% rate.
Yeah. Okay. So you find out about their underlying mortgage, but you're not saying, hey, if you have a cheap mortgage, sell your house to us.
No,
Right.
definitely not.
Okay. And how long have you been in the business?
Well, total 21 years, but on the investing side for about 15.
Okay. So 15 years. So really you started in the Great Recession.
Yes, I was an agent from 2005 until 2010.
Yeah. Okay. And what's interesting about that is this market of distressed homeowners has become much, much smaller since then. In fact, there's very little distress in the market because so many people have these very cheap mortgages. Comment on that if you would, because you saw it in a market where people were going to foreclosure sales and they were sourcing all kinds of properties from distressed sellers, but that has just, especially during the COVID era, largely dried up. Tell us about operating in a slimmer market of potential sellers.
Yeah, I think it's really interesting, man, because there were certainly parts in the country where 1 in 6, 1 in 7 houses were behind on payments,
Yeah, not
and
anymore.
yeah, and that's a colossal supply of motivation.
Right.
But I think that there's more motivation, more distress than what people realize right now. And what I would look at is Google search terms to really identify that. So if people
Mhm.
are typing in "sell my house fast" and that is trending upward, then that's an indicative of more financial distress or other distress to get rid of property.
It
And
might be, but let me just unpack that a little bit more.
yeah,
I mean, nowadays, the more and more aligned we are with technology and the more capable that technology is, the more we just randomly search everything we think
mhm,
about. Like every thought that comes into our mind, we
mhm,
search it nowadays, right? And what about this? What about that? It's not like we're doing it with a lot of intent because the barrier to searching something is so easy. You can just ask Siri. You can just do it by
certainly.
voice. You don't even have to type anything. Just because people are sort of like considering something, I think what they usually do is they find out it just doesn't make sense. They've got a much better deal than they think they have,
Mhm.
right? Comment on that if you would.
Yeah, I think it really depends on what time frame you're really analyzing it. So, of course, if we were analyzing that same search term from 2024 to 2014, that there's so many factors that would be variables within that would maybe disassociate any type of relevance between those two data sets. But if we're looking at it on a 90-day trend, then I think
Yeah.
that we can look at it because it's so closely related. It's like, oh, we've got a 15% bump or a 20% bump, and we have seen that.
Mhm.
So I think that gives us a little bit more reliability in what that data might mean.
I wonder how much of that comes into play with the election. These people thinking that the end of the world is going to happen if Trump gets elected, or the end of the world if Kamala gets elected, which
Right.
probably actually will be the end of the world. But, how much of that plays into an election, too, is an
Yeah,
interesting.
certainly could be. And like anything, if you try to do one-to-one analysis, it's almost impossible to do. It's
Yeah.
like everything's a multivariate equation. And certainly I think that has impact.
Yeah, definitely. Okay. Talk to us about, how you negotiate the deals. I mean, how do you structure them? Subject to is your favorite thing, right?
Well, actually, what we call some now, some later is probably my favorite because that's when we get a 0% rate.
Tell us about that.
Yeah. So everything that we do is predicated on never making an offer, never giving a price. So whenever we negotiate, I don't want to be in a position where I'm giving an offer. And there's three reasons for that. So number one, an offer in my world is a commodity to shop. So many of your listeners have been in a situation where they've given an offer, they want to think about it. That's reasonable. And now you're getting shopped because they're calling everybody else and saying, "Hey, can you beat this price? Can you beat this price?" So many of your listeners will remember they'll think, "Oh, that happened to me on this house. I know it." Right. So that's the first thing an offer is a commodity to shop. Number two, a lot of times the price that your seller will give you is going to be lower than your price. Okay. So I've had many times where, we went in kind of thinking, well, this is what we could pay. And then they say, well, this is what we would take. Okay. And we always go with their number because I've also had times what I used to do was I would say, well, my number is this. Why don't we go with my higher number? Okay. Because I don't believe that you should always, just because someone will sell at a discounted rate, that is always the moral, ethical thing to do. Okay. Now, I stopped doing that because what I found out was that people would, in their minds, discount because they know of problems that you don't yet know about. So
Hmm.
now we're in a situation where we will go with the lower price. And then if the deal works out the way that we hope, then we might cut a check back to a seller, okay, after the fact. So we do that at times. But number two, the seller's price is going to be lower than your idea of what you would pay. So it's a type two error, right? So it's an unrealized gain if you give your offer and it's higher than what they would have accepted. And then number three, not giving an offer puts you in a situation where you can get to deal structure easier. And so that's what we're talking about with sub two or some now, some later. So the idea of we always negotiate based on price first. So we assume that we're going to get a price that is so good that we would pay cash for the deal. Okay. Now, sometimes that doesn't happen. Either they are unable or they are unwilling to take that price. And so we're in a situation that now we have to switch to terms. So Jason, and many of your listeners know that price is a function of terms. So everybody looks at price as all cash at closing. But let's say that a house is worth $250,000 and the seller wants $1 million. Well, we can come up with a deal structure that we would pay $1 million. Now, it might be $10 per month until paid at 0%, and we turn it to a rental and cash flow it. But price is a function of terms. So if we're negotiating a deal and we can't get to a price that we would pay cash, then we switch to terms, which is the beginnings of, well, if there's a loan, we might go sub two. If there's a loan in a big equity position, we go into a more of a hybrid structure. If it's free and clear, then we go into a some now, some later deal where we give some cash at closing and then payments per month, which is at a 0% rate. And some of those deals can be your best deals. And some of those deals don't actually have price equity. The real equity is in, hey, these are only principal payments.
Right. Yeah. And it's interesting. I hope everybody noticed how you pointed out there's equity in that cheap mortgage, right? There's equity in terms, right? So you don't even have to get a good price. The tens of millions of people that have these ultra cheap mortgages, the mortgage is an asset. I've been saying that for 21 years. And, it's like, I think people are finally coming around to understand that, especially with the low COVID era mortgage rates. That's just a huge asset, regardless of the amount of equity. And now Americans have a record amount of tappable equity that they've never had before. Regardless of that, just their low rate mortgage is an extremely large asset. So that makes them likely to not want to give up that house. That's the mainstream part of the market for sure. But
absolutely.
But yeah, money is always made finding opportunities. And that's exactly what you're doing. Anything else you want to share, Brad, before we wrap up? Just anything in general, could be about market outlook or any of the kind of deals you're looking to negotiate or whatever.
Yeah, I'd like to talk about commercial for a little bit. It seems like commercial is under major distress, and
and when you say commercial, which part of commercial? Are you going to say office or what?
Office is what I'm really looking at. We just recently bought a $2 million Class A office building, $500,000 down, and the balance at 0%. And so this thing pays off in 6 years, and it's in an A class part of Nashville. And so we're seeing for the first time, this distress, this type of distress in corporations that hold these assets, even free and clear assets, that they can't rent them or whatever. And I've got a friend of mine that just bought a 22-story building for $3.4 million in Chicago.
Wow.
It's unbelievable to me that these deals are coming available. But literally.
Right. But what's the reuse of that? I mean, there's still no demand, right?
I agree on that.
Is it a residential conversion or is it just a cheap office building that you're going to rent for much lower rates to whoever will rent it? What is the plan? What's the game plan for that property?
Well, for the 22-story one, man, that's beyond my pay grade. So I have no idea.
All right. For the stuff you're doing.
Yeah, the office building that we picked up, we're able to turn that into more of a co-working space and do very, very well at that. So that is one option. There's different ways.
Is it a co-working space you're operating or just leasing it out to Spaces or WeWork?
So we are operating it.
Okay. That's a lot of work. That's a business.
It is, but luckily it's where my team is anyway. So there's on staff people there, to help us
right.
come up with that. So it's worked out well. But I think that there's tremendous opportunity with that. The naysayers on the market, they're always going to say the market crash is almost here. I don't suspect that that's the case, again, outside of a black swan event. I think that we are going to have a little bit more inventory than what we're used to seeing. But, I saw this in 2006. I remember one builder in 2006.
Wait, are you going back to residential now? Or?
Yeah.
Okay.
Going back to just the overall market, I think that there's a lot of opportunity in commercial, but back to residential, people say, oh, the next market crash is here. I think it's all about perspective. And when your perspective is a house should sell in 6 days and it takes 60, that feels like a crash.
Right.
But if you're from the world of you have a little bit more perspective and a little bit more experience,
right?
3 or 4 months is a pretty good time turnaround to sell a house. So if it's 60 days, that's actually not a crash. So there's always going to be opportunity, and I think that it's a great business to be a part of, and I'm excited for what the next 5, 6, 7 years looks like.
Good stuff. Well, Brad Smotherman, thank you so much for joining us, and I concur on your optimism in terms of the market. There's just a huge rental demand and purchase demand coming at us. Well, it's already here. We all know that, but there's a few doomers out there who just keep publishing their clickbait, don't they?
Well, one year they'll be right. Here in the next 20, 30, 50 years, they'll be right. And they'll say, I told you so the whole time.
I know. It's so funny, like they say, a broken clock is right twice a day. They'll eventually be right. The problem is, and I'll just leave you with one more thought that's kind of interesting that I've been thinking about. I've been saying this on the show, is it's interesting that if you invest with someone and they lie to you and misrepresent the investment, of course you can take them to court and sue them, right? Because you got damaged based on their bad advice or their fraudulent advice. But why is it that no one sues the doomers who basically prevent people from investing because they lie to get clickbait, to get views, to get clicks on their blog post or views on their YouTube video or whatever, right? We should be suing them for the missed opportunities because tens of millions of people have missed opportunities because they fell for their doom and gloom forecast. And I mean, these people are intelligent, some of them. They have to know that they're lying about what they're saying. I mean, I look at like the YouTuber Nick Jarelli, right? I've watched a lot of his videos and I've saved them. I've saved screenshots of them because his predictions have just been so wrong, although he sounds right. But if you really analyze it, they just conveniently like leave out a few really important details and make these kind of leaps in logic. And that's why they're just wrong. It's interesting. But comment on that?
Yeah, for sure, man. I think about this all the time because most attorneys and most CPAs will tell you what not to do. And it really comes down to, in my opinion, just the idea of conservatism. And, there's risk on their license for telling you the wrong thing.
Right.
But the thing is, you only know if it's the wrong thing if you do something you shouldn't have done.
Right.
If you don't do something you should have done, that's an unrealized gain.
Right.
So it's the idea of unrealized gains versus realized losses.
Mm-hmm. Yeah. It's like the old saying, you can't hear the dogs that don't bark. And the dog that sort of doesn't really bark is the stuff you didn't do.
Yep.
And how you lost out by not taking
That's
action, right?
That's it.
If you take action and it doesn't work out, you really see that and feel it. But if you don't take action, you sort of think, I missed the boat, but maybe I didn't, people rationalize that all kinds of ways. So very interesting talk. Brad, thanks so much for joining us.
Appreciate it very much. It was great.